Hello everyone! Today we are going to talk about the financial analysis of the financial statement for Virgin Blue Holding Ltd. Firstly, I'd like to introduce our group members to you. My name is ZHANG Sisi and I will do the first part of this presentation, which involves the background information of Virgin Blue.
Hello everyone, my name is ZHANG Hong and I will respond for the second part of the presentation talking about the structure of the company.
Hello, my name is XIE Lidan. I will introduce the third part of our presentation. It's talking about the reporting practice of the entities.
Thank you. First, we will move on to the first part. First part talks about the principal activities for this year. According to the director's report, we can find the principle for this year was continued strategic development and operation of its domestic and international airlines. Also, Virgin Blue has separated its international airline business from the Virgin Australia Holding Limited, with all the shares transferred to a wholly new company called Virgin Australia International Holding Pty Ltd. And on March of this year, the new structure was effected by the company changing the way of distributing its shares of a pre-data basis of dividend in specie. Second part about the consolidated profit. We can easily find from the income statement of Virgin Blue that the net profit after tax attributable to its shareholders was 22.8 million Australian dollars. For the CEO, John Borghetti was appointed as CEO from 2010 and also for this year. And his relatively remuneration was $4,072,000. And for the auditors, the KPMG Australia performs the audit service for this company. And the total audit fee was $3,573,000 and it was comprised of two parts. The first part is statutory auditors and reviews, which accounts for $1,390,000, and the other one is the other service other than the audit, which accounts for $2,183,000. For the subsidiaries, Virgin Blue has total 38 subsidiaries for this year, and they are all 100% owned, and no subsidiary is less than 50% owned. There are two foreign subsidiaries among them. They are Virgin Australia New Zealand Holding Pty Ltd and Virgin Australia New Zealand Employment and Crewing Ltd respectively. That's the end of my part. Thank you.
And thanks for my partner Sisi. And now I'm taking over from here. Question number 6 asks about the associates or the investment in joint controlled entities. For the Virgin Samoa Limited is associated with the Virgin Blue. It accounts for 49% of the ownership interest. And question number 7 asks about interest in joint controlled operational assets. According to the Australian Accounting Standard Board 131, that the joint controlled operational asset must be unincorporated or not partnership. However, the joint venture, the Virgin Samoa Limited, is incorporated in Samoa, so obviously there's no interest in the joint control interest for that one. And question number 8 asks about the consolidated goodwill. For 2012, the Virgin Blue's goodwill comes to $43.8 million and no accumulated impairment loss occurred at this year. And the theory behind it is subject to an operating segment scaling test for the purpose of the goodwill impairment testing. Procedure used to which goodwill has been allocated have been aggregated so that the level at which impairment is tested reflects the lowest level at which goodwill is monitored for internal operating purpose. And number 9 asks about the tax consolidation group. The company follows the tax consolidation legislation since 1st April 2003. These tax amounts are measured as if each entity in the tax consolidation group continues to be a standalone taxpayer in its own right. And number 10 asks about the segment disclosure. The Virgin Blue follows the domestic and international segment disclosure operating, and it's based on the geographic features. And for the domestic one, they The revenue recognition will be the ticket sales from them, and for international segments, they use different aircraft types, and their revenue occurred at the point of the sale for the other service than the domestic one. And the question 11 asks about this group structure, and we can see clearly from here to tell the story of the relationship between the parent entity and the 100% owned subsidiary and 49% owned interest for the associate. That's my part, and we'll hand over to my partner. Thanks.
Okay, let's move to my part, the third part of the report practice of the entities. The first one, I will introduce the accounting method of the group. In the subsidiaries, the group has used the purchase method of accounting. According to ASB 3, this involves 3 steps. The first step is identifying a new acquirer. The second step is measure the cost of combination. The last step is to allocate the cost to the assets. And the most important part of this standard is that the unrealized profit and expenses should be eliminated before preparing the financial report. And in the associates, the group has used the equity method of accounting. According to ASB 128, the investment has initially measured at cost, and the carry amount increased and decreased to the recognize of the investor's share of profit and loss. Okay, let's move to the last questions. In terms of the new consolidation, the ASB 10 introduced a new definition of the key entry. It extends the range of the key entry. That means it increases the number of consolidated entities. And in the Virgin Blue, it has already established the special purpose entity, and it is also be consolidated. And the ASB 11 introduced a principle-based approach to accounting for joint and arrangement. And the new standards, 2 changes has happened. The first one is instead of existing 3 categories, joint operation, joint and joint venture has been introduced. And the second change is removing the proportion method and method for accounting. The equity method of accounting must be used. So the group has already adopted the equity method. And move to the ASB 12. About the disclosure of the interest in other equities, it requires that more requirements should be disclosure, such as key estimations, risks, and judgments. In our group, according to Note 33, the liquidity risk, credit risk, and market risk has been disclosure. Let's move to the last one, standards, ASB 13, fair value measurement. That requires all assets and liabilities measured at fair value, including non-financial assets and liabilities. But in our group, this standard has not already to be used. That is my end of our presentation.